$3 trillion market cap for crypto. Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee, and joining me are my co-hosts, CoinDesk Managing Editor of Global Capital Markets, Lawrence Lewiton, and Managing Director of International Content, Emily Parker. Good morning, Emily. And Lawrence, hope you had a good weekend.
Yeah, I mean, not $3 trillion of a weekend, but it was pretty good, yeah.
All right, well, let's have a live look at Bitcoin right now. The CoinDesk Bitcoin price XBX index is currently trading at $65,422. Bitcoin is shooting up almost 6% over the past 24 hours. And the CoinDesk Ether price ETX index is at 47.18, making an all-time high earlier, up about 2.25%. And the new DFX, CoinDesk's DeFi index, is at 656 points, up about 2.6% over the past 24 hours. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto news, events, and data. So, Lawrence, about that all-time high, ETH earlier shot to 47.67, and the crypto market cap is at $3 trillion.
Yeah, $3 trillion. I mean, if you think about it, if they seized it, they could almost pay for some of these spending programs, but I don't want to give Congress any ideas. One of the interesting points to note is that Bitcoin dominance is in the 40-ish% or so right now, which means that if you took the $3 trillion, multiply it by 40%, that's just Bitcoin's share. Earlier in the year, at the start of the year, it was closer to like 60, 70, some odd percent. So it shows that what that tells us is that it's not just about Bitcoin now. It's of course about ETH, which is hitting that close to 4,800. It's about Solana and all these other altcoins that have been growing tremendously. So it's more of a statement about the market interest in crypto and the growth of all that. And we're now changing to maybe a new chapter in the crypto markets, and I think that's kind of, maybe it's driven by some of the spending, but it could also be just mere interest in it as well.
Mm-hmm. All right, and Emily, also the infrastructure bill was passed, but that wasn't so good for the crypto industry.
Yeah, what's happening is a little bit counterintuitive. We have this infrastructure bill passing with this crypto tax provision that many in the industry warned would be disastrous for the industry, and we have Bitcoin soaring. So there are many possible explanations for this, but apparently the market is not seeing the infrastructure bill as disastrous as many crypto advocates had warned.
All right, well, moving on, the Biden administration's report puts the ball in Congress's court to regulate stablecoin issuers like banks. The report is getting mixed reviews from the crypto industry. Let's have a look at our spotlight guest.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
All right, joining us now to discuss the Biden administration stablecoin report is Acting Comptroller of the Currency, Michael Hsu. Welcome to the show, Michael. So I looked at some of your comments, and you described stablecoins as awe-inspiring. What did you mean by that?
So I think the technology is very, very interesting. I think that it's what it has done is really opened up avenues to do things in a new way, and that's awe-inspiring. That's interesting. I think it also comes with some risks. So we want to make sure that as that develops. And it has developed and grown very, very quickly. I don't think anyone thought we would be here today with stablecoins at over $100 billion, with the speed with which the crypto universe has developed. And that, I think, puts the onus on us as regulators to kind of understand the space, make sure that it develops safely and soundly and doesn't have any threats to financial stability.
Okay, why are stablecoins a problem when they solved a problem that the banks couldn't solve without regulation? That is more efficient cross-border payments, global liquidity, cutting down settlement times. If that's the case, why do they need regulation now?
Well, I think your question makes some assertions that each of those could be challenged or each of these can be turned over. I think it's useful to think about, to look at history. So in the history of the economy, the banking system, stablecoins remind me of pre-Civil War banking. And in pre-Civil War banking, you didn't have a dollar in the way we know it today. each bank issued a note, and that note represented $1. So that looks an awful lot like a stablecoin. That system was very unstable. There were lots of runs, there were lots of panics, and it wasn't until the National Bank Act, the National Currency Act under Abraham Lincoln that created the dollar as we know it today, and which also, incidentally, is part of the OCC's history. That's when we came into existence, which resulted in a more efficient, fair, and stable financial system, and that's what we all want.
It's a pleasure to have you on the show. We have a brand new report out on stablecoins with recommendations for Congress. I was wondering if you could break down for some of our viewers who are not familiar, very specifically, what you think are the good aspects of this report, what recommendations you would agree with, and what you think is still missing or some recommendations that you think could be improved.
Sure. I think the report's primary recommendations are spot on, and that is what is the biggest risk of stablecoins, especially as they scale and that they get more used? It's that they're subject to there's run risk there. They're subject to runs, and how do we deal with run risk? Well, we know that from the banking world, we've got a way of dealing with that through a prudential framework. So that phrase, a federal prudential framework, is all about how, over many, many years, we've learned how to deal with run risks so that we get all the benefits that are provided while mitigating the risks. So that's number one. I think the other risks that have been cited, with regards to payment chains risks and concentration, those are also things that we need to keep an eye on. And we're trying to get ahead of things here so that we're not constantly reacting in a way that can lead. We want to be smart about how we do this. And so part of this report is trying to look out into the future a bit and try to get ahead of that, start that conversation, so we can get these things in place. So things can. Everyone wants these things to scale. We want it to scale too, but we want it to be done safe and soundly. We want there to be consumer protections, and we don't want there to be financial instability risk.
So yes, thank you. Just to follow up on that though. So yes, we've identified some of the risks, which are runs, but just looking at the actions that are recommended, I'm just really curious to hear your perspective on which actions you think, or which recommended actions you think are correct and which you think are not correct.
Well, I think the way the way the report's laid out is that first best would be congressional action. Because if Congress can take action, they can tailor the framework. They can do that through a deliberative process. It has legitimacy. All the voices can come to the table. We can do that in a way that's clean. That's good. That takes time. And so in the meantime, while the industry grows and expands and evolves, what are the tools we have to address it? The report talks about FSOC. FSOC has certain powers and tools. We will use those if we have to, and FSOC is actively discussing that. At the same time, we've got certain regimes which could be utilized, such as getting a national bank charter, et cetera. But those are voluntary in nature, and so the landscape, as you know, there's a variety of players out there. And what I've been trying to get out there to talk about is, well, let's try to use the tools that we have so we can differentiate between safe and sound stablecoins and those that are less regulated and not as safe and sound.
So, Comptroller, one of the stablecoins not subject really to run risk is Tether, because they limit how people can redeem $4, and it's an important point because more than half of all stablecoins right out there, that more than half of the value is in Tether. So they operate outside the United States. What happens to them specifically? Let's name names, because the report itself just sort of hints at it. But what specifically happens to the largest player, Tether, and also to USDC, but really Tether, which is by far the market dominant player?
So I'm not going to opine, kind of hypothesize on government actions towards specific coins. I think it's premature for that. But I would note that there is a range. As you know, there is a range in how these stable coins are set up and the confidence that users have in them. And I think that when times are good, that range tends to be narrow. In times of stress, we know from the 2008 financial crisis and other stresses, that range widens. And then once there's panic, you can't put that genie back in the bottle. We know that. And so what we're trying to do is set up a regime where stablecoins are in fact stable. That is in the interest of everybody. But that's not a free proposition. That requires choices to be made. And I think that what you're seeing right now is that different stablecoin issuers have approached that differently. We're trying to lay out a path so that there's clarity on that, because we hear from you and a lot of your viewers that people want clarity. Just tell us what the rules are, and we'll follow that. So we want to lean into that and be part of that conversation.
So when you mentioned different stablecoins are set up differently, obviously, some have as close to pure cash as possible backing them up. Some have come up with the innovation of having commercial paper backing them up. Should they be regulated differently based on that setup, or should it be one size fits all with stablecoins? Why not have, let's say, the SEC regulate those that are set up with commercial paper, and CFTC maybe regulate those that are algorithmic based, and you guys regulate those that are dollar based, or the FDIC for that matter? Why not just do it based on how their asset base looks like, instead of just the fact that they call themselves stablecoins?
So look, I'm open to engaging on this conversation and talking about it in more detail. My prior, without knowing more of the details of what your proposal is, my prior is that run risk, the bank regulatory framework is familiar with and knows and understands run risk. Run risk is not something that investor protection rules under the SEC or trading rules under the CFTC are good at dealing with. We know that from history, right? Money market funds are regulated by the SEC. Money market funds have had endured runs, and that's one need to look for. March of 2020 last year, 2008. Those runs can be very destabilizing, have broader impacts on the economy. We want to make sure that those are prudently managed. And again, the bank regulatory framework knows how to do that. But I'm open. I'm open to ideas on how to approach this. My experience is that the fine nuances of what you talked about, Lawrence, would be lost on the public. As a practical matter, I think the public is going to say, a stablecoin's a stablecoin. Let me just trade in it until there's stress. And then people start looking at the fine print, and those reaction functions we have to take into account. And we have experience with that. So we want to bring that experience to bear.
Yeah, I guess following up with Lawrence's comment, if based on the different asset backing of stablecoins, do you see different regulatory agencies in the U.S. Having oversight over different stablecoins based on that asset backing?
Not at this time. Again, I think we're getting ahead of ourselves. I think what we're talking about here is a proposal. I haven't heard a proposal along these lines, and I think it had to be fleshed out considerably more to be taken seriously. But let me just note, in the bank space, the way banks hold high quality liquid assets to deal with runs, those portfolios vary. It's not one size fits all. There's rules around them. We try to set those rules so that there's clarity and there's certainty, but there's also some flexibility within those rules. So we're used to that. So it's not hard for me to envision, Lawrence, like your proposal being done within a regime, within, say, a bank regulatory regime that can achieve some of that. So, but again, I think we'd have to look at the details on this. I'm open-minded about it, but I think we want to keep our eye on the ball.
Oh, well, I noticed in your comment,
stablecoins need to be stable.
I noticed in your comments that regulatory arbitrage played a role in the 2008 financial crisis, and so how can you see that being avoided going forward with stablecoins? Is it that all agencies should find some sort of unified way to deal with stablecoins, or different agencies will react to them differently?
So I think, and thank you for highlighting that. So this is something I feel really, really strongly about. The number one way to stop regulatory arbitrage is for the agencies to cooperate and to get on the same page and to basically lock arms as to what the vision is for going forward. And I think that's really, really important. We all have our individual mandates. That's not going to change, but we can coordinate on how we do that. The PWG report on stablecoins is a great example of how we can do that. We came together. We basically said, okay, how are we thinking about the risks? How are we thinking about the recommendations? Let's do that together. And what that does is it prevents us from basically setting up our own sets of rules and then getting arbitraged by players out there who want to pick and choose from different parts of those rules. This, I think, provides a healthier way to move forward. There's a lot of devilish details. I don't want to get in front of. We have a long way to go, but I think it's a good start to preventing what you're talking about.
But does the OCC or any other agency that you can think of have a problem with U.S. dollar-based stablecoins, issuing those stablecoins against non-U.S. dollar currencies or other assets, but denominated in one-to-one U.S. dollar, such as, let's say, commercial paper, for instance, has been one topic that people have talked about, but it could be other assets. Is there kind of an issue, a worry that this is effectively money printing that can happen on a grand scale if that's the case, if it allows non-U.S. dollar currencies, for instance, to be used as that currency to purchase those stable coins?
I see. Well, I think there's two things here to unpack. So one is, and again, I'm going to sound like a broken record, but the number one thing to guard against is run risk. That is number one. So whatever we can do to mitigate the risk of a run, that is job number one. Within that, should there be flexibility? Yes. Like we need to have flexibility within those bounds. But we have to be very careful about trading off the flexibility for run risk. We've seen this before in the past, because again, confidence, once you lose confidence, it totally unravels. And you can say till you're blue in the face that the portfolio has a value of X, but everyone says, I want my money back right now. And we've seen that. And so what do we need to do to prevent that? Within that, are we willing to be flexible? Yes. But again, we're not going to prejudge the degrees of flexibility here on this particular call. I just invite your viewers to review within the liquidity risk the LCR, the liquidity coverage ratio for banks. There's flexibility built into that. There's experience with that came out of the runs from the crisis. Review that, take a look at that, and you'll see that it's not as strict as people might be thinking, but it is grounded in kind of our experiences and analysis with regards to liquidity risk.
Let's just shift away from stablecoins for a moment to decentralized finance, or DeFi. And I was just wondering if you could talk to us a little bit about what you see as the best regulatory approach to DeFi, because DeFi is decentralized and thus difficult to regulate in a traditional way. And there have been various DeFi projects warning that if the US kind of oversteps and regulates DeFi in the wrong way, they will leave the United States. So this has been a topic. So how do you, simply put, what are your big recommendations for regulating DeFi?
Sure. So let me just start off the bat, because as the acting comptroller of the currency, I'm approaching these DeFi, crypto, the entire space with three lenses. First, what are the impacts on bank safety and soundness? That's my number one job. That's my mission, to ensure that banks are safe and sound. So to the extent that banks get involved in that space, that's my question. Second, what are the impact on consumers? Does this space help or hurt with inequality? Does it help or hurt with financial inclusion? That's really, really important. Third, what are the impacts on financial stability? And so those are the three questions I constantly ask myself as these are developing. In the DeFi space, I think right now, the safety and soundness and financial stability implications are second order. I think the primary one is really on consumers. And there are some really interesting polls that show who is getting into the space. It's not who you think. There's a Morning Consult poll that asked fully banked versus underbanked, do you own crypto? 10% of the fully banked said yes. 37% of the underbanked said yes. Who are the underbanked? Underbanked, they have a bank account, but they often need to go to a check casher or a payday lender to fulfill their financing needs. Juxtapose that. There was a Harris poll. Do you own crypto? Whites, 10%. Blacks, 18%. Hispanics, 20%. So I think we want to be really careful about who is in this space and why, and what the risks to them are. I think there is some promise of wealth creation, of empowerment, et cetera, of innovation. But there is some risk that folks who are least able to bear it lose their money. And I think we want to be really careful. That's something that I and some of my peer regulators are focused on. How do we regulate that? I think is an open question. Like the how, we're trying to figure out right now the what, and we'll figure out the how. Because as you guys know, the regulatory structure right now, it's not well set up to just apportion which agency tackles which problem. We're still figuring that out.
I want to get back a little bit to the stablecoin issue because it perhaps ties into this, and that is this. What kind of transparency is going to be needed for stablecoins to provide that they aren't currently doing right now to keep that stability? Do you think, for instance, last week we had Jeremy Allaire, the head of USDC, yep. And we asked about some of their short-term assets, and he said, look, we disclose what we're required to disclose, but the question from the market has been, is that many don't feel that's enough. They don't know how much of those assets are potentially at risk. So how much transparency is there? How much transparency still needs to come out into the market that maybe goes above and beyond what's currently required?
So this is going to sound like a flip answer, but as much as is needed to maintain confidence through different states of the world, that's what's needed. And so I have personally been in situations with either banks, non-banks, money funds, others, where there's a question of what's there, and that's the inability to answer that question confidently is what leads to the run. So you can't solve for that. Once you're in that situation, you cannot solve for it. You have to solve for it ahead of time. That's going to feel onerous. Almost by definition, it's going to feel onerous to stablecoin issuers. But again, this is a policy call. This is why we have regulation, is to help define these rules of the road and to give investors and users that confidence that, okay, what's there is there. I can focus on other things. It's not a good use of people's time to be constantly fretting about that if we can set up guardrails for that.
Nonetheless, I mean, is enough currently out there? Are the rules that whatever rules we do have enough to deal with that market pressure, that market nervousness and confidence? Do stablecoin issuers need to disclose more, regardless of where they are and who they are? Are they doing enough general, right now?
In general, my answer to this is always going to be more transparency is good. So that's my general response. But again, I think what we want to do is kind of evaluate the space carefully, analyze it carefully, come to our recommendations in a smart way. So yeah, I mean, in general, you'll hear me now say they should disclose more. But I want to be careful that doesn't kind of become a headline. The OCC requires more disclosure from stablecoins. We have to be cognizant of where our authorities lie right now, and what my word means.
What is the right balance between stablecoin risks and stifling innovation? As many folks in the crypto industry are one of the recommendations in the report is that these issuers be regulated like banks, and does that limit fintechs that are trying to issue stable coins? And folks in the crypto industry feel that unnecessarily singles them out when payments firms like PayPal have similar functions.
So I think we want to be careful on this, where innovation, that word is getting thrown around a lot in different contexts. And I want to be really, really clear. I am not against innovation. Innovation is good in most instances. What I want to be really careful about is when you're dealing with other people's money, which is what stablecoins fundamentally are about, you want to be careful. We all want to be careful. And there are some areas where we want really unfettered innovation. Move fast, break things, iterate. That's what you want. With regards to stable coins, I would argue that is not what you want. You want your money to be stable. You want it to be reliable. You want it to be there in good times, in bad times, and not have to think about it. If you innovate too much in that space, you're going to get a wide range of outcomes that, and some of which are not going to be good. We've seen that in other spaces. And so again, we're not out to quash innovation across the board. I would argue that the best way to promote healthy, productive, responsible innovation is to take those things which should be stable and make them stable so people don't have to worry about that. And then that way you can focus your the innovation energies where they can kind of have the biggest gain.
So finally, and relatedly, do you think the United States needs a central bank digital currency, i.e. a digital dollar, and why or why not?
So I know the Fed is working on a paper on CBDC, so I'm going to withhold judgment until I see that.
All right, Comptroller, thank you for joining us this morning. Great to get your insights on the topic of stablecoins and more. That was Acting Comptroller of the Currency, Michael Hsu. Coming up, checking in on Asia and the crypto markets update with crypto exchange FTX US.
CoinDesk Indexes, the market standard for crypto assets since 2014. Our trusted data powers billions in publicly traded funds. CoinDesk Indexes are the standard used by institutions, and they're the key for investors looking to understand and access crypto markets.
CoinDesk Bitcoin Price Index, XBX, has been instrumental to Grayscale, enabling investors around the world to access Bitcoin through a regulated, familiar product.
CoinDesk Indexes enabled the early adopters to build crypto investment vehicles, and they're already trusted by a new generation of global investors.
Time now for the daily forecast, an update on what's happening in the Asia crypto markets. Here's Mega Chadha of Forecast News.
Welcome to the daily forecast, November 8th, 2021. I'm Megha Chadha of Forecast News, covering all things blockchain, filling in for Editor-in-Chief Angie Lau. Ethereum, the world's second largest crypto by market value, hit an all-time high for the second time within a week, Monday morning, Asia time. We'll take a look at what's driving markets and a whole lot more coming up. Let's get you up to speed from Asia to the world. Let's kick off with some of the top stories out of Asia today. South Korea's Financial Intelligence Unit has confirmed that NFTs are not virtual assets, with an official telling local media they will follow the FATF's updated crypto guidelines, which explains that NFTs used as collectibles rather than as payment or investments will not fall under the category of virtual assets. This may mean they will remain exempt from Korea's upcoming tax on virtual assets. And Beijing is going the blockchain way. The city's municipal government has invited $37 million worth of bids to purchase a blockchain platform and hardware facilities to handle government affairs. The platform will be used to record resident IDs, sign and approve government documents, and offer a coding system for buildings and roads in the city, among many other things. You can find more on those stories at forecast.news. And the cryptocurrency all-time highs keep on coming. Ethereum has been on a record run since late last month, and according to CoinMarketCap, it hit $4,736 Monday morning Asia time. Forecast News' Lachlan Keller has more on what's behind those moves.
Ethereum's new record comes after the crypto trading platform Bakkt, which listed on the New York Stock Exchange last month, issued a press release on Friday saying it is expanding its offerings to include Ethereum. Bitcoin also rose almost 5% in the 24 hours to Monday morning, and one expert told Forecast News we cannot separate what we're seeing with Ethereum from what's happening with Bitcoin.
We're going through a period of kind of accumulation, which is interesting at these price levels, but that's what's happening. And once the kind of supply shock kicks in, then I think within this month, we can see Bitcoin for sure go above 80K, and that should take Ethereum. I think actually Ethereum can touch $6,000 by the end of the month. Caseland
sees widespread bullish Q4 sentiment around the flow of announcements coming from the crypto space, with another example being Solana Ventures and FTX push into initiatives around Web3 gaming. That saw Solana hit an all-time high of just a touch over $260 on Sunday.
I think over the coming weeks, we should also be paying attention to Polkadot, which it's been kind of a slow mover over the past few months and is now really breaking new kind of charting new all-time highs.
Caseland says all of this also fits into the meta-narrative that has been spurred on by Facebook's change of name. For Forecast News, I'm Lachlan Keller.
Meanwhile, with the Chinese cracking down on private tutoring sector, one edtech company is pivoting into blockchain and crypto mining. Nasdaq-listed Meton has taken the plunge by announcing a strategic partnership with AGM Group Holdings, which includes an initial order for 1,500 AGM crypto mining machines. Forecast News' Timmy Shen reports from Taipei, Taiwan.
The former edtech company, which officially changed its name from Metten EdTech Education Group to Metten Holding Group back in August, initially announced that it was planning to venture into the blockchain and cryptocurrency business in September. That statement said the company was contemplating the purchase of mining machines and NFT assets with a view to putting the machines into operation in the US or Canada. It has now moved those plans forward by entering into partnership with AGM Holdings, with its initial order for 1,500 Bitcoin mining machines worth a cool $12 million. The agreement also has an option for the purchase of additional machines in the future. Metten had built a network of almost 150 learning centers across China since it was founded in 2006, driven by demand for private tutoring in the country's highly competitive education system. However, a crackdown on the sector was announced in July, with the government saying it was aimed at reducing the pressure on both children and parents. Metten says it chose AGM to enter into partnership with because of its expertise in design and production of chipsets. However, just last week, its chip design partner Shenzhen Highsharp was accused of patent infringement by mining hardware manufacturer Canon. For Forecast News, I'm Timmy Shan, Taipei, Taiwan.
And that's the daily forecast from our vantage point right here in Asia. For more, visit forecast.news. I'm Megha Chada. Until next time.
The Crypto Markets Update is presented by Grayscale, the world's largest digital currency asset manager.
Checking in on Bitcoin, the CoinDesk Bitcoin price XBX index currently trading at $65,457. Bitcoin is up about 5.6% over the past 24 hours. And the CoinDesk Ether price ETX index is at 47.28. ETH also up about 2.5%. And the new DFX CoinDesk's DeFi index is at 655 points, up about 2.4%. Joining us now to discuss the crypto markets is FTX US CEO Brett Harrison. Hello there, Brett. So, crypto hitting a $3 trillion market cap, a new milestone. ETH is at an all-time high, was at 47.67, and Bitcoin dominance has gone up from 70% earlier this year to down now to 40%. So, how do you interpret all of this?
So for me, it really feels like we're entering a next stage of the development of the crypto infrastructure and ecosystem where people are looking for what we're going to do next with crypto. I think Bitcoin as a store of value and as a mean of transfer has been incredibly important for the development of this space. But next, we're really looking at applications. Applications are everything. So when you think about the layer ones that really let people build applications on top of the blockchain, of course, primarily Ethereum, the first blockchain to really bring smart contracts to the world. But now, especially things like Solana, which have smart contract support, they let people build applications of all kinds, but can do so with very high transactions per second, very low cost. This is why there's so much interest now in things like NFTs and gaming and ways of using blockchains to harness that next power of technology. That's why we're seeing such growth now in things like Ethereum and Solana, and now it's not all just Bitcoin.
Hi, Brett. Do you have any regulatory concerns, particularly in the U.S.? I mean, regulation of the crypto industry has become a hot topic. Is there anything on the horizon that you're particularly worried about?
We're keeping such an active, pulse on what's going on with regulation in Washington. We're looking very hard at what's happening between the two main regulatory agencies dealing with markets, the SEC and the CFTC. I think when this infrastructure bill got passed, and yet we're still seeing all of the coins, nearing all-time highs or reaching all-time highs, I think what we're seeing is that the knowledge that regulatory action is coming for the crypto industry is sort of already priced in. We all realize that in order for there to be longevity in this industry, there has to be clear rules, clear guidelines for especially these licensed gatekeepers like FTX that are responsible for making sure that users, customers' funds are safeguarded, and that we're making sure there's no money laundering through the system and these kinds of safeguards. We expect these to come, and we want to be a part of it. And I think that the comptroller had a lot of good insights about why regulation is important for things like stablecoins. There's a lot that history can show us about cases where innovation gone completely unchecked has resulted in problems for ordinary consumers. And it's important for us to put those things together in perspective of what's happening now and make sure that there are safe rules of the road for continuing innovation in the space.
Mm-hmm.
So, what did you make of Comptroller Hsu's comments? Besides that part, I mean, is there anything else that stuck out in your mind with what he just said a few moments ago on our show?
Yeah, I was particularly struck by, interested in the comparison to historical banking systems, and thinking a lot about, for example, a fractional reserve banking system, which left unchecked might have the ability to handle withdrawals and deposits in a sort of median case where everything is functioning fine in the economy. But in a case where there's a large run, that's when you start to see systemic risks really come to light. And that's what I think drives one of the most important aspects of the PWG report, and what we think is one of the most important aspects of ongoing stablecoin regulation, which is transparency. You have to take something like USDC, which focuses a lot on having a 100% reserve digital currency. And in that sorts of cases, if you can really prove that that's the case, if you can have transparency and show that you have full either US dollar or very high grade commercial paper backing the stablecoin 100%, then you're not as worried about a run risk. You can let people withdraw 100% of the stable coins and get dollars from them. But if you have something where you have riskier assets on the book, if you don't have full 100% reserve on the books and people don't know about that, well, that's when you can end up with a problem where if everyone wants to redeem their stablecoin at the same time, you can get into a lot of trouble. So to me, I think that's the most important aspect of what we think is a sound stablecoin regulation. And it seems the comptroller agrees, based on his comments about, the history of, pre-Civil War banking.
Would that apply? Well, when looking at Tether and seeing that apparently a lot of their assets are backed by commercial paper, is that something that perhaps should be further regulated?
Yeah, I think it's completely sound and reasonable for there to be certain requirements on stablecoin providers as to, what are the costs around creation and redemption? What guarantees that there can be roughly, free redemptions and creations at large or infinite sizes based on their reserves? What are the actual nature of the instruments being held at the institution? What licenses do they have that give them the ability to act as a depository for these kinds of instruments in the U.S.? I think these are all perfectly, reasonable regulations that should, absolutely apply to Tether, as with every other main, stable coin. Tether being just one of them.
FTX is one of the largest customers of Tether. Have they made any appeal to them for that kind of transparency and increased self-regulation?
Sure. Just to be clear, FTX itself is not a customer of Tether. I think that we are certainly our customers who are doing large amounts of trading with Tether and USDC and several other stable coins as the quote currency of the pairs that we allow on our exchange, have made a number of direct connections with the Tether folks and appealing for them to be more transparent about their books and their assets, because our customers know that creation and redemption of Tether has been possible and easy and has worked well for all this time, which is why it's grown to such a large amount. But we want to make sure that we're dealing with stablecoin providers that do play well with the rules required in the U.S. to be a good actor for being basically essentially something like a bank and being able to issue these instruments. And we support that wholeheartedly.
All right, Brett, thanks for joining us. Appreciate your insights. That was FTX US CEO Brett Harrison. Let's check in on crypto Twitter with our tweet of the day. And this one has a bit of a buzz. Elon Musk, aka the Lord Edge from Trollheim, tweeting, "Much is made lately of unrealized gains being a means of tax avoidance, so I propose selling 10% of my Tesla stock. Do you support this?" Yes, about 58%. No, saying 42%. What do you guys think? Should Elon Musk be paying his taxes or not? I don't know.
Yeah. Go for it, man. Go for it. But we know, we know this was kind of a publicity stunt. But yeah, sure, Elon, keep it up.
All right. That's it
Why
for
not?
First Mover. Thank you, Emily Parker and Lawrence Lewitton. I'm your host, Christine Lee. I'll be back live at 3 p.m. with all about Bitcoin. Coming up at noon is The Hash. You're watching CoinDesk TV.